Hi everyone, this is Jason Birak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager. He's a newsletter writer of Addicted to Profits, and he's also an author. He's published a couple very popular books. His most recent one is Collapse! How the Federal Reserve Created Another Stock Market Bubble and Why It Will Collapse. Dave Skarica, thank you for joining us again.
Thanks for having me.
Now, Dave, about the title of your book, I think I remember speaking to you, it was probably around November or December of 2014, and you expected the stock market, the general stock market in the United States, to start running out of steam, the indices to stop moving higher. Why don't you think we've collapsed yet?
Well, I think number one is just actually the only reason is all the liquidity around the world. Every time we get a weak economic number, the Fed is going to push back. I don't even know if they're ever going to raise rates. Personally, but I don't think they are. But they're going to use that excuse to push that off, and then people think that's more liquidity, and that's awesome. That means that the market can hold up. And I think this kind of final surge, I think it's a blow off in the European bond markets due to their QE. I think what actually has happened is everyone lifted their lifted their sells, just as let the ECB pump up the bond markets. And now is going to dump their bonds to the ECB, and that's going to push up yields. And if you look at, there are signs that the Italian and the Spanish yield have bottomed, meaning the bonds at top, and it's starting, the bond markets are starting to roll over. But I think what happened was you got, these are large economies, and, they have large financial sectors. So all of a sudden it pushes everybody into equities. So I think that has kind of propped it up. Then we've got this blow off and kind of a mini bubble in China as well. So I think, with all the liquidity, but what happened is if you kind of look at, it's the exact opposite in a way of 2013, 2014, where the European equities were struggling and the U.S. would kind of prop them up because it was in this huge bull. Now the U.S. equity market is kind of struggling, but these kind of parabolic moves in European markets and Chinese markets have kept it higher and higher. But we're seeing some serious technical erosion right now. Actually, I'm a little more confident than even I was last year. I thought we might see a crack last year. We saw a correction into October, and the market kind of sprung right back. But the reason I'm a little more confident now is we have a sell signal on the Dow theory. For those who know where the Dow theory states that the transports and the industrials have to move to each other and confirm each other's moves. Okay? So we go look at it. You'll see that the transports actually peaked intraday last December, did not confirm any of the Dow's new highs this year, and have actually begun to roll over. They're under their moving averages. The 50 days sloping downwards. The 150 days about to roll over and slope downwards as well. So that is a sell signal. That happened in 1999 as well, a few months, by the way, before the tech blow-off. So we have that. There were only 20 new highs yesterday on Thursday, the 16th. On the S&P. The S&P was basically within 1% of its all-time high, and only 20 of the 500 companies were making new all-time highs. The stocks above the 50 and 200-day moving averages has essentially been trending lower since last summer. So these erosions in internals is what you usually see near the end of bull markets. So obviously I want to see what's going forward here. I think the first part of earnings, we've seen kind of these relief rallies, like, this isn't as bad as we thought. They're beating the kind of depressed numbers, they set the bar really low. But I think at the end of this earnings season, you may see this kind of realization that, hey, okay, maybe it wasn't a complete disaster, but, no one's raising their guidance. No one's raising their estimates. It's still pretty dreary. So that is when the market could really, really start to kind of roll over. And what I would suspect is that these sectors and indices that are struggling, they'll do, this would happen in late 2007, they'll do a lot worse than the actual market. And after the first 5 or 10% decline in the market, you'll see a rally, and you'll see those sectors that are lagging not really even barely bounce on that rally. And that will be a sign that we're about to move lower. Because what makes this difficult is, people talk about don't fight in the Fed if they're going to raise rates, and that's not going to happen. I think they're in the game of chicken. They're trapped. They're not going to be able to do it, because the only reason you have a slight recovery in the economy is because they've inflated bubbles, right? The 1%ers can go buy their cars and their fancy houses in Florida. You had a bubble in high yield energy, which led to the fracking boom due to easy money. So the easy money has caused the boom. So then the tightening of the easy money cuts off the boom, which means then the economy goes back to where it was in 2008, 2009. So they really can't do anything right now, you know.
Sounds like the Austrian business cycle theory to me. Yeah, sounds like we've just had, you know, this easy money and easy credit boom, and we haven't had the bust yet that people who follow the Austrian School of Economics are expecting.
Yeah, and they always blame the 37 bust on the Fed, right? But if you actually look at it, right, there was actually tightening in bank lending standards, and because Roosevelt decided to balance the budget, so many companies become very dependent on, like, you know, government contracts after the New Deal that it really hit their bottom lines, and you have this big decline in the stock market. But see, like an Austrian, which I tend to lean more to that view, would argue that the problem wasn't really the Fed, quote unquote, tightening like bank lending standards in 37. The problem was all the easy monetary policy, say in the latter part of that boom in 35 and 36, which led to kind of this huge explosion in the stock market. Just like today, the stock market basically from 34 to 37 at a 3-year period where it doubled with no real corrections. So I would argue that the easy money caused that 37, 38 recession, not the Fed tightening too soon. And by the way, that is what they're basing all of this on. Everything is based on 1937. They don't want to tighten too soon. But I think at some point, it doesn't matter. You look at Japan. Japan says 0 rates for 20 years, okay? And when you have 0 rates like that, Japan has had numerous 2, 3, 4-year rallies in the equity markets, followed by 1, 2-year declines that are sometimes 50 or even 60%. So at some point, this is going to run out of steam. And I think what makes the next bear market, and this is why I titled the collapse, so bad is that we have all this financial manipulation going on right now in terms of stock buybacks, companies' ability to go to zero and borrow at 1%, and then they can increase profit margins. Obviously, we've had no wage pressures, you know, for the last few years, also helps their margins. So we have had all this kind of financial manipulation going on, right? And engineering going on in Wall Street. So if you look at it this way, okay, you have a huge amount of margin debt. You have the largest purchasers of stock right now are companies buying back their own stock, and you have ZIRP. Well, let's say you get a credit crunch, and then companies can't buy back their own stock. Then all of a sudden, you have this huge void of buying that just kind of evaporates, and then the market can just start gapping down. And then you've got high frequency trading and you know, robot algo hedge funds that are all going to go from a buy to sell when the uptrends are broken and the trend changes, and then they go from buy to sell, and then there's no one there buying stock. I think you're just going to have a lot of flash crashes and a lot of like mayhem during this bear market. And that's my final note, that we've never seen a bull market like this that is so engineered by the central banks. So I think one of the big mistakes people are going to make in this bear market is thinking that there's going to be big rallies, the market's oversold. And just like this bull market didn't really see declines when the market was overbought, I don't think you're going to really see the rallies that people are expecting when it gets oversold.
Dave, because of all this manipulation everywhere, and you've named a good amount of the examples, and I'm sure you and me can name a whole bunch more, probably spend the rest of the podcast naming examples of manipulation throughout the whole market by different groups. Do you find it more difficult to be a contrarian now more than ever before in your investing career?
Oh, yeah, because, like, first of all, just to get to this point of being a contrarian, the biggest thing I'm actually just about to do a series called You Have Been Warned. And guys like Carl Icahn and Paul Tudor Jones and guys who used to trade with Soros, they're all warning right now of a huge market meltdown coming. Like Paul Tudor Jones and his main fund never had a down year, and he made money during the 87 crash, and he's warning that this is another big, huge disaster coming. But the average person, always writes me that, the Fed's not going to let the market go down. We're in this great new secular bull market, et cetera, et cetera, et cetera. So I think it is difficult to be a contrarian, because one thing that Kyle Bass is fond of saying is that the average person's mentality or time frame when it comes to the market is 2 years, which means that they think that whatever has happened in the last 2 years will happen permanently in the future. Well, what's happened in the last 2 years? In the last 2 years, the stock market has gone straight up with no 10% pullbacks, okay? So it goes.
Yeah, and that's historically unprecedented, right?
Exactly. Like, I'll tell you something else in a second. So that's why I find it to be a contrarian, because the average person has, I agree with Bass 100%, has that 2 year kind of mentality. So they don't think the market can go anywhere but down. And then, too, when you're like myself, I really started getting bearish like early to the mid part of last year. So I was early. It'd be like getting bearish the market in mid 1999 or, mid or late 2006, right? Eventually you were right, but when you're wrong for 6 to 9 months and the market does go up, then people just kind of look at you as being, one of those broken clocks that's going to be right twice a day. But I'm not a perma bear. Like I didn't really get bearish until, mid 2014 or so. So I think that's another thing that makes it difficult. And then, you've got all these, like you said, these parabolas like biotech, certain stocks in the chip sector. Actually, a lot of the most dangerous stocks are the most widely held ones. Again, go look at long-term charts of Disney, Nike, etc. They've just gone completely parabolic in the last.
The market's desperate for yield, man. The market, people are desperate. They're moving out of their people who would normally not be in the stock market. They would be in these money market funds, right? Sure. Where they could get 10 years ago they could get 4 or 5%. They can't get that anymore. So this financial repression that the Federal Reserve, Japan, and Europe have done, it's forced people like that to put the money into dividend stocks.
I don't know if it's forced them, though, because they're making that decision. Now, okay, maybe that's their plan. They forced them out because they bought all the bonds, too. But, like, you look at Nike, for example. Nike just has over 1% dividend. So you're not going into that stock for yield. You're going in that stock for growth. Now, you'll pay up for a growth stock because you can't get any yield anywhere. So that definitely has helped inflate it. So I'm not so concerned of why that's happened. That is the driver of it. But it's more that those type of charts of these kind of large cap companies are completely unsustainable. Like go get a 20-year chart of Disney and put it on a linear scale, and you'll see what I'm talking about. It is completely unsustainable what has happened. So, like, regardless of the reasoning for it, So, and probably the last time, like Nike, for example, had a move like that was like, the late 90s bull market. And then Nike basically went from 16 to 6, after that occurred. So, that's the kind of declines I'm looking at in these big, large cap stocks. And that's much more dangerous than the bubbles in biotechs, because biotechs aren't really widely held by the public. That's more of like a Wall Street thing and speculation thing. But stocks like Nike and Disney and those types of things are very, very widely held. So that actually, those in a lot of ways pose more threats. So anyhow, I just think it's very dangerous. So this gets to the point you talked about how that's not the norm. Well, I did a quick study, very simplistic, and I just tried to find a 3-year period in the stock markets when you had a doubling in the indices without a 10% correction along the way. And there was basically 5 time frames I found. And they were 26 to 29, 34 to 37, 52 to 55, 62 to 65, and 84 to 87. All of them ended in a bear market. The only mild bear market within a secular bull market was the 56 bear market. And then 87 was a crash, 66 was the start of the secular bear market, and 37 and 29 were crashes. So 3 of those 5 time frames ended basically in crashes, and 2 of the time frames in 29 and 66 ushered in secular bear markets as well. So it's really like, if you're buying here, I would say buyer beware. And if your reasoning is, it's because the Fed is not going to let stocks go down and rates are 0, well, it's just, I think that's the whole, it's not, it's not different this time.
Now, there seems to be enormous pressure for a lot of contrarians and value investors. They're not, maybe in the past they were given more time to let their investment methodology play out, because normally with value investors, most of them at least, they don't produce, these Paul Tudor Jones trend trading hedge fund type of consistent returns every year. But, over the longer time periods, they produce enormous returns like Sir John Templeton and Warren Buffett and those guys, because the longer you go out, the more, you allow the value plays, your contrarian value investing methodologies to play out.
Well, here's one thing, though. Warren Buffett has changed a lot now. He's doing leveraged buyouts now, like the Tim Hortons and that sort of thing. So, yeah, Warren Buffett was like that, I would say, but he's kind of, I think, changed a lot in the last 10 years or so. So I'd be interested to see how his fund performs now, now that this bull market is kind of, begun or whatever, or if a bear market begins. Templeton, he's more of my mentor, and Templeton basically has a quote. If you go on YouTube, you can find an excellent documentary that Bloomberg showed on him, and he basically and what I love about this documentary, there's about 5 or 10 minutes at the end. They just have these old interviews with him, and one of the interviews he says, never buy where the outlook is good, always buy where the outlook is bad. So where would John Templeton be buying today? And actually, these are only about the 2 places where I have long equities. He was never a fan of precious metals, so I don't think he'd be buying. He might be buying some mining stocks, but he didn't like precious metals. I don't think he'd be buying there, but he may be buying some of the other miners, which are depressed. Actually, I'm saying 3 places. That. Then also, he probably would have been buying Russia, and he'd probably be buying Greece. Like, those are the places that he would be buying, and those are the places that the mainstream financial media, if you read articles, will basically tell you their basket cases and to completely stay away. So, like, that is the kind of investing I like to do. And the problem is, with the central banks around the world inflating asset prices, they have made buying what Templeton called maximum pessimism very, very, very difficult. Okay, and so I would look at like I said, Russia and Greece are 2 of the only markets. I mean, Russia needs to pull back a little bit because it's been on fire in the last 3 or 4 months. But I think those are what you should be looking out for. And if you're used to Templeton brand of investing right now, like I said, you would have positions in those 2 markets, and then you would just be waiting on everything else. And by the way, Sir John Templeton shorted all the .coms in the early 2000s. So he would probably be shorting the Netflixes and the Teslas and all of these hot momentum stocks right now. And by the way, 99, 2000, he actually was down quite a bit on the shorts. He shorted too early, like in late 99, and then he doubled down in 2000. So just because you're short, and I know because I've tried to short some of these things, it's been difficult, but just because you're short and lose some money doesn't mean that ultimately you're going to be wrong, because when a bear market happens, these bubble type stocks are going to fall. It's like the Nifty 50 did this in 74 as well, as long as the .coms in the early 2000s. These companies will fall 80 to 90%, while the rest of the market falls 30%,
Yeah, and a lot of those smaller bubble stocks, a lot of them don't have great financials. So if you go and look at the financials, some of them don't even have free cash flow in some of the technology industries. So like Twitter and some of these social media ones, some of these biotech ones, they're all on hype. They're not, is the FDA going to approve this drug or that drug, or they're in phase 3 trials and the FDA is about to approve it and the stock just doubled in the last couple months. That's what we've seen in the technology industry lately in the last couple of years.
Yeah, if you look at Tesla and Netflix, those 2 are trading very much like the .coms. In that, remember that in the .coms in the late 90s, companies were going up because of page views and, number of people visiting their site and stuff like this, right? Well, Netflix, even though it makes money, it's going up based on subscriber growth. But Netflix actually had their worst quarter ever in terms of free cash flow last quarter, because they're trying to, basically spend all they can to grow subscribers. So all people care about Netflix is, and they have a huge off-balance sheet liabilities, by the way. But anyhow, all people care about Netflix is subscriber growth. Tesla, all they care about is, they sold twice as many cars this year as last year, even though their valuation, say on a per car basis, either by market cap, cash flow, enterprise value, whatever, is 40 times Ford. So that's what's happening, and that is very reminiscent of the late 90s and those 2 stocks. That you're just putting out an arbitrary number that's really not helping much with the bottom line, and people are going crazy over that and those kind of stocks. And then, like you said, in these smaller companies, you have negative cash flows. Some of them might not even be making money. But I'm telling you, even there's a large cap blue chip company I'm short right now. And this company has a north of $30 billion market cap, and it has $200 million in cash. So, like, you're seeing, this is a pretty well-known company as well. So you're seeing stuff like that, too, because through financial engineering, this company is able to, basically grow their EPS at 8% a year. So people are giving it a premium valuation right now. So I would say that, Yeah. On the whole, you're seeing these kind of massive overvaluations. Then, actually, just last note, in many ways, we're more overvalued than 2000 now. Like the median price to sales number on the S&P is the highest it's ever been, higher than 2000. And the reason being is because through financial engineering and keeping very, very high profit margins, companies are trading at a big premium to sales right now. So I would kind of ignore the PDE on the S&P because so much of that is financial engineered. It probably should be 50% higher than it is. Like really the PDE on the S&P probably isn't, the 17 or 18. It's probably like 24 or 25 if these companies were not able to do all this financial engineering. And remember, that's similar to the financials back in 2007, that they were all trading at single-digit PDEs, but basically the E was garbage. The E was all financial engineered through high-leverage products that all blew up. So right now the E is kind of engineered. So I don't even think, like for example, the non-engineered E is GAAP, right? And GAAP right now we're trading at like 21, 22 times earnings. Yeah.
And the accounting standards of the last decade or 2 decades, if you went back in the accounting standards company used back then, talking to more old-timer, more experienced people in markets, the accounting standards have changed drastically. I mean, I get invited on LinkedIn now. I'm in the finance club or whatever. It's a group on LinkedIn. And I get invited to these financial engineering conferences, every couple months for people in chief financial, who are CFOs, who can learn how to engineer their earnings and, finagle the financial statements even better. To goose, so the numbers don't look anything like reality from the operating business. So I think that's why if you're doing accounting and you're trying to look up investing in a business long term, you have to understand free cash flow and stuff like that because they just goose so many of the different financials now that are released to the public.
Yeah. No, I agree. It's very difficult to know now. And because everything is about meeting your number every quarter and all this sort of thing and all, it's very short-term outlook. So yeah, there's just a lot of goosing that goes on, and it's probably the type of thing that will blow up. And and there's going to be, I bet you, I'm willing to bet when it's shown to be how disastrous many of these stock buybacks are right now, I'm willing to bet that you're going to see some sort of restrictions on stock buybacks, in terms of how much you can do, how they can be done, probably after this bull market. Now, that may be set up by the SEC, or these companies may do self-imposed restrictions on it. But I think when you're going to look at companies like Caterpillar and IBM, who are basically destroying their balance sheets to buy back stock, to inflate EPS, I think that when those kind of stocks collapse in a bear market, and all they have is debt-laden balance sheets with, awful financials, you're going to see this kind of maybe, and actually almost maybe activists against the activists, because the activists are probably the reason why these companies buy back so much stock. And I think that you might see a reaction against that. Just like, people wanted more, say, financial regulation after the financial crisis, right? So I think you're going to see more regulation against stock buybacks and the whatnot. And the problem with all this loose money, it actually is kind of playing into the hands of even though it's not pure capitalism by any means, but it's playing in the hands of what Karl Marx said. And he used to say that capitalism would destroy itself, the proletariat would rise up and blah, blah, blah. Well, these financial markets, regardless, like I said, I don't even consider these guys are like crony capitalists. I don't consider them true capitalists, but they're almost going to destroy themselves because in their greed with all this financial engineering and stuff, it will end up leading to a bigger implosion down the line. So maybe it's more like Keynesian capitalism that is going to blow itself up. But whatever the case is, I think that you're going to see this. I think it's just more this kind of crony capitalist Wall Street mentality that is going to blow itself up after this bear market.
Yeah, exactly. The Keynesians, the fascists, the people on Wall Street from both parties, they're not thinking long term. So if you're running your company, and I think this even goes, Dave, to the people at the board of directors of the company who are supposed to be stewards for the shareholders, there needs to be incentive plans in place so the people at the company, they care what happens to the company 5, 10, 15, 20 years down the line so the company doesn't have too much debt. It has a bunch of whole new products and services. It spent money in research and development to create new monopolies and new markets. we're not seeing the incentive structure for the management teams of these larger companies to do that. Instead, they're doing exactly what you said with the financial engineering. So they beat, by a penny every single quarter. Their stock options packages trigger, even though they're loading the balance sheet with debt, and they're not making sound long-term decisions. And, yes, they're going to get rich quick in 3 or 5 years and get their golden parachute and stuff. But in 10 years, the company could be in a lot of trouble.
Yeah, that's exactly what you're seeing is that, it's just like, in terms of M&A and R&D, it's just like, you always know there's going to be bear markets and there's going to be bust. So as a corporation, and hell, even stock buybacks, as a corporation, there's going to be a bear market. If you really want to buy back stock, just wait till, I don't know, the price of your stock declines 30 or 40%. So then you're actually buying it back at a cheap level. And if you look at most of these buybacks, like last peak for buybacks was 2007. What was that, right? The last low in buybacks was 2009. So these companies are awful inverse indicators. And like I said, the problem is, like you just said, they're destroying their balance sheets and the actual corporation at the same time.
Well, most of these buybacks, Dave, are not on valuation. They're by the corporate executives to game their stock options packages. So they don't give a shit about the valuation. They just care about, beating by a penny so they can get their options packages. They may say to the public that, oh, our stock is a good value, but they don't really mean that.
No, of course. Like you look at Caterpillar put in a big buyback last year when the stock was still north of 100. And I can guarantee you when that buyback expires, if this stock is still at $80, $85, the board of directors of Caterpillar is not going to have that much incentive to do a new buyback because their options are all at $100 or $105. Well, it's just, there's no incentive because, what are you going to do? It's not going to jack the stock up high enough to exercise your options. So, and I hate when they use that term. This is, I guess, what it's end off in this point. I hate when they use that term. They say they're like, you're giving money back to shareholders. Okay, a dividend, yeah. Okay, that I get. But a buyback is not giving back money to the shareholders. A buyback, 90% of the time is like you just said. It's to inflate the price of the shares so these corporate executives can exercise their stock options and, and appease a couple of big activist investors. So that's what really buybacks are all about. And like I said, I think that is just going to end up being a total disaster at some point, Because my feeling is if I'm a hedge fund and I got a big interest in the company, to me it's a huge conflict of interest that I'm appointing board members to this, and whatever. Bill Ackman does a great job of it, but it's this is what I personally think. It's a conflict of interest to appoint board members and get them then to buy back the stock that you have a big, interest in. So I think when some of these companies blow themselves up, you are going to see that sort of like heavy duty activism really, really crack down on. Or who knows, maybe money won't have to be cracked down because maybe a lot of these funds will just blow themselves up and they won't even exist. So.
Yeah, I mean, and this is what cheap money and cheap debt and financial repression, it causes asset bubbles and trillions of dollars in misallocated capital. So whether that's, China's historically unprecedented central planning with, massive oversupply of copper and iron ore and steel, or, the corporations these large corporations who have access to unprecedented cheap debt, who are doing, share buybacks or leverage buyouts and things like that. These are all, unintended consequences of central banking monetary policy. Switching gears, Dave, to the next topic, I want to talk about the oil market. In your opinion, do you think oil's starting to put in a strong bottom?
Yeah, I think we are going to bottom here in oil. See, what I did is I always look at like I talked about those 3-year bull markets with no corrections. So I look at what's the most common trading pattern to oil in its history to what we've seen in the last year where it just totally fell apart. And in terms of also of the background of it, a lot of it was caused by the unwinding QE and also though then the supply side where the Saudis decided to not cut supply and basically they're putting frackers out of business or trying to, like how the U.S. put the Soviet Union out of business in 1986. So that's the time frame. It's not like 2009 because oil was collapsing with the rest of the market. It's not like 79, 80 because that was again the end of the secular bull market in oil. It's like 1986 where Oil was kind of flatlining for a couple of years, around $30 a barrel, then fell off a cliff to $10 when the Saudis pumped up production. And they always do it for their own means, by the way, right? Like they were doing it to bankrupt the Soviet Union, but not really to help America, because if they bankrupt the Soviet Union, their train of thought was the Soviet Union production was collapsed, and then the Saudis would gain more market share. So this time, they kind of did it under that guise, by the way. Supposedly, they were telling John Kerry they'll do it to help the U.S. with Russia, but they're really doing it backhandedly to bankrupt the frackers. And the frackers have done a good job of bankrupting themselves, because many of these companies have debt to EBITDAs of 3, 4, 5, sometimes even 40 or 50 to 1, right? So the frackers, you know, when they go under, can't blame the Saudis. They have no one to blame but themselves. So what I'm saying, though, is when the oil market tanked in 1986, it wasn't like it had a V bottom and this turned around. Basically, most of that year, it spent, like it basically started in late 85. It went down for about 6 months into about the spring of 86. There was a quick rally. We might be in a similar rally right now, from about $10 a barrel to about $16 a barrel. And then it went back to 10 during that summer in 86 and bottomed. Okay, so what I'm thinking is, then we had a 70% decline. This time it was roughly the same, going from about 115 to 44. We could be in the midst of that kind of rally right now. And then probably sometime, I don't know, like middle of this year to later this year, we might retest these lows or go back into the 40s. And then that will be it. By then, you'll start seeing I think the fracking oil production really like starting to decline. And you're not going to really see it start up for a while, because so much was based on junk debt. And obviously, banks are not going to give junk debt bond loans after half of these companies go under, right? Even if oil's back at 80, you know. So I would say, yeah, between now and the end of the year, but also because I'm so bearish on the stock market, other than very, very unique cases and companies that are very, very cheap, I'm a little bit apprehensive about buying oil and gas companies, because more than precious metal companies, oil and gas companies, like a company like Exxon, for example, tend to trade more with the stock market. So if you get a 15% or 20 or 30% decline in stocks, they're going to trade lower with the stock market. So even if oil prices stay where they are, you know, those stocks could fall 20% with the stock market, and I would look at buying them then. So I'm kind of thinking that you want to buy the oil and gas stocks over the second half of the year at some point. But there are some good values, and if you see something that is cheap, I have no problem with someone putting their toe in the water as of right now. But I think you got to make sure what kind of company you have. Like a lot of these trackers are absolutely toxic. They've been issuing, some of them have been even issuing shares to try to stay alive. They're just pumping out oil and gas to pay, you know, interest on the debt. And and because fracking deposits only have 2 to 3 year lifespans usually, they're just a disaster. There's a whole bunch of them that are just going to go completely bankrupt. And by the way, those assets are going to be of interest to no one, because, you know, that's the big argument. Oh, when this happens, there'll be a change in assets. Because those assets, it's like a shoebox home in Detroit or Cleveland during subprime. That was they bulldozed those, okay? Because the cheap money was the only reason that half these properties went into production. So a lot of these properties won't even be of interest to someone when the bust kind of after it happens.
Yeah, a lot of the technology of it, what most people don't understand is a lot of the technology, the fracking technology itself, most of it, although there's been some improvements lately with multi-pad drilling and multi-stage fracking, things like that, but the general fracking technology has been around for many decades. But what allowed the shale boom to occur, the fracking revolution to occur, was high oil price plus cheap debt. Those were the two main factors behind it. And, you know, now the cheap debt, like you said, may eventually evaporate because it was junk bonds and people thought the oil price was going to stay high or go higher. And now people are a lot more bearish on oil. But, you don't have the oil price at $100 a barrel. And by the way, Dave, even when oil price was at $100 a barrel, we weren't seeing most of these fracking companies generate free cash flow, really.
Yeah, a lot of them were losing money. Not even just cash flow, but actually losing money. And then it's almost like a Ponzi scheme. Like, let's raise more junk debt just to drill more and, just keep going that way. And another interesting point too about the oil and gas stocks, just a note here, is that Jason and I know the gold stocks and resource stocks and mining stocks all too well. And that one of the things that's really killed those companies, and one reason they didn't bottom right in 2013, was that once the price of these commodities come down, the SEC rule is you have to value the value of your property on where it is basically the first week of the quarter, okay? Your average price over the year as of the end of the first week of the quarter. Well, as of early October in 2014, the average oil price was still like still like $90 a barrel. So like CLR, for example, Continental Resources, they were still valuing the value of their properties at $92 a barrel, based on $92 a barrel oil, right? So we look at CLR and we see that, right? And now, like, that means this quarter they're going to have to probably the average price over the last year as of early January is going to be more in like the 60s. So then you're going to see massive write-downs, and I don't think a lot of these companies have quite discounted those write-downs. You look at something like EOG, which is one of the leading factors, that one is not going to go under. But you look at a company like that, maybe they have like a discounted that, you know, the company is going to make a lot less money, but I don't think they discounted the big non-cash write-down that's coming down and the actual value of you know, the assets in the ground. And many gold and precious metals companies over the last 2 years had big gap downs and that sort of thing, you know?
Yeah, I could see companies like EOG perhaps getting bought because they have more assets in the sweet spot and better acreage and not as much debt. But, you know, a lot of, in the oil industry, you're taught, at least like decades ago, you're taught not to drill on debt. But because the debt was so cheap, so many of these shale oil producers, and they didn't hit dry holes, they took the debt anyway, and they figured that they could, you know, hedge their oil or natural gas production, and they'd be okay. And no one in the oil industry really, you know, expected the oil price to drop 50% from June 2014 to what it is right now. So, you know, you have a situation here where the hedges are starting to come off. There's a lot of debt on the balance sheet, and, you know, a lot of these oil companies are desperate to either sell more shares or for a buyout. I know companies like Whiting Petroleum, which I think they're the second largest producer in the Bakken for oil. You know, they did an ill-timed acquisition of Kodiak with massive amounts of debt, like 5 months ago or something. And, you know, even though they did an emergency capital raise with debt and equity at punitive rates, they're still, I think, desperate to sell the company to a larger major.
Yeah, for sure. Because they got a huge amount of debt. Now they got to mark down the value of the assets. And, you know, like, look at that stock has collapsed from 92, Whiting, to, you know, it's about 35 right now, and it was as low as 24. But I don't even think that probably discounts how bad this is. And then we have a lot of the regional banks in the Midwest. I think these are actually a great way to play it on the short side, because these companies have, a lot of them, between 15 to 20% of their total loans outstanding are directly to energy. So it's the same thing that I don't think the market, and I've traded some of these things. Some of these things are only 10% off their highs. The market has not discounted how much that is going to affect them. Just look at, if you're a company like a Texas bank or an Oklahoma bank, you have, say, $1 billion in loans, and 150 million of that was direct to energy. Well, out of your other $850 million loan portfolio, how much of that are the mortgages of people that work for those energy companies or supply those energy companies? And remember, they say for like one manufacturing oil and gas like job, that creates like 3 or 4 other jobs. So we've seen about 100,000 job losses in the oil and gas fields. So at some point, that's going to, say we end up seeing 200,000. Well, that's probably going to create about 1 million job losses, you know, across, you know, places.
The service industry, like at shopping malls and restaurants and stuff like that, that were the oil service guys who are making 70,000 or 100,000. The petroleum engineers were going after work.
And how much, you know, how many of those banks' loans are to a restaurant, you know, are to the mortgage of the people who run the restaurant, right? So it just, to me, I look at it and I go, again, it's hard to know because you can't really see the makeup of the individual loans, who these people are. But you would think that if you have 15% direct loans to energy, you're probably got a 60 or 70% exposure to your loans to people who are related to that industry. And of course, if 10% of those loans default, 6 or 7% total, in fractional banking, that's it. You're done. Your bank is insolvent, right? So I think a lot, but this takes a while to pan out. Just like the Wall Street banks slowly began to move lower in 2007 and didn't really escalate to the downside until about mid 2008, right? And even though March of 2007 was really when the subprime started blowing up, so it really took a year and a half for that to play out. So it could, this kind of started in the fourth quarter of last year, so it could still take 6 or 12 months for those kind of shorts that play out right now. Like, for example, I'll give you one that I actually have a put position on. BOKF is one, and in their last quarter, they made 0 provisions for bad loans to the energy, and they're the highest one, by the way. 19% of their loans are directly to energy. So like they made 0 provisions, 0.
No loan loss reserves whatsoever.
No loss reserves in the last.
Whoa.
And the CEOs, and it's really funny. Here's what's really funny about them.
That's like Lehman Brothers or Bear Stearns type of.
Here's what's funny about them. Their CEO made some kind of comment that the Texas economy or whatever, these economies in the Midwest are diversified, and we're not totally dependent on energy. And there was a bank in the early 80s, a Texas bank, I think it was the largest bank in Texas at the time, actually, in Houston. And their CEO made the exact same comment in 1982, and the bank was bankrupt in 1986.
Well, people don't learn from history, Dave. You and I both know that.
This is where timing is everything, because I'm actually down on my short on that because the stock rallied with the rest of the market recently, but
oh, it rallied with the higher oil price, right?
Higher oil price. But it doesn't. See, and this is the last point on that. That doesn't matter because all of these things, like you said, were cash flow negative at $100 oil. They at least need $80 to $90 oil to be economic. So $60 oil or $40 oil means jack, and you know what? There's no difference. Those properties are completely uneconomic. The loans are complete garbage at either 40, 50, 60. It doesn't matter. Yeah.
It means the bank's probably going to have to sell some emergency shares then, and they're going to give some type of excuse about how their loans are not expiring, but they need to do an acquisition. Maybe they'll make up in the press release how they're going to do an acquisition, why they're raising these shares or something, when the real reason is they needed to cover the oil loan losses.
Yeah, and and go look at it. You're going to see, and you saw this back in 2007, 2008 with these banks. You're going to see all kinds of gap downs and the stock, from the stock price perspective, when this news finally hits and stuff. Because like you just said, it's very similar to these companies just kind of BSing everyone, right? And it could take a while. Like, for example, Bank of America.
Subprime is contained. And I think what the oil junk bond market is larger than the subprime market was, right?
It is. Yeah, it is. And junk bonds, energy and junk bonds was only 4% of the total junk bond market in 2004. It's now 14%. So it's going to have a much bigger influence on the junk market as a whole. But just to quickly end off here, here's the thing I'm talking about. Like in March of 2007, that's when subprime really started to blow, Bank of America was like $46. In October 2007, it was still $46. It was still as high as $40 or $37 in May of 2008. So these things can kind of like hold up for a while, but what will happen is, like, for example, from May of 2008 into the summer, it went from 37 to 17. And the only reason it rebounded back to 37, Bank of America then, and by the way, by the end of the year it was 14. But the only reason it rebounded even to 37 is because they made short selling those stocks illegal for a bit to try to save the banks. But anyhow, that's just what I'm trying to say though, like, a lot of these things will just crater right near the end. You just don't know when that's going to be. So,
timing is the most difficult part of investing, right?
Yeah. Now, there's a famous story just before we move on to that. I think we're going to talk about the U.S. dollar, but there's a famous story by Jim Rogers that I love that he talks about in 1969. There was a really bad bear market in 69, 70, and he talks about how he went broke almost because he bought put options on the futures market, because he knew the market was overvalued and then tanked. So anyhow, just to finish off quickly here, he knew that the precious metals market was, the stock market, but his futures weren't further enough out, and he almost completely wiped himself out. And then he ended up being totally right. In 1970, the market had a really bad bear market. Actually, the 1970 bear market, no one ever remembers it, was almost as bad as the 73, 74 bear market. It was like 36, 37%, right? So
I've read all of Jim's books, and Jim did go bankrupt at least once. I don't know if it was on the trade you described, but he got greedy on the shorting, and he got the fundamentals right, but he screwed up on the timing. I mean, the timing on the long side, timing is tough. That's why you can't go put all of your money in at once, because timing is just so difficult. Even if you're really good at technical analysis and you're a patient long-term investor, timing is just so difficult on the long side and on the short side.
Yeah. So one thing I've started to do, just before we move on to the last thing, is I'm actually starting to use when I do puts, I'm using more leaps because of that timing factor, right? I can't get it exactly right, so let's try to get something a year or 2 years out rather than a month or 2 months out. So that's kind of what I've started to do. And even if you have to pay the premium, if you get a huge bust, you're gonna more than make up for that premium.
Yeah, I agree. I think the best way to do shorting is either with a long straddle at a certain strike price, maybe one or two different strike prices, or with puts. Yeah, or I think those are like the best way to manage trades like that and give yourself some time to let it play out. Because, rationally you think that, oh, this can't last for, longer than a certain amount of time. And then, history tells us, Dave, that these things, they always go quite a bit higher, especially with the technology bubble, than people thought they would go, or they always go normally a little bit lower than people thought they would go too. Like, look at gold and silver. Gold and silver has stayed lower for a lot longer than most experts expected over since 2011 in the cyclical bear market.
Yeah, and that includes me. So with gold and silver right now, it looks like we're building a massive bottom, right? It looks like, and like you said, it's just the timing. So my advice to people is get small amount of your portfolio, own a high quality gold and silver miner, or the bullion or whatever, and just wait. That's really all you can do at this point, because when you kind of out of this bottoming formation, which has probably been forming since 2013, it will blast off to the upside. Right now, we're hitting kind of very short-term resistance of the highs we made a few weeks ago. And then we got the highs in January as the next resistance. And then we got the highs of last summer. And actually, those are also the highs of the summer of 2013, et cetera, as the next form of resistance. But when we break that, which is about 280 on the HUI, we will go up and that's 100 points from here. So that's what I mean. You got to be invested right now a little bit, because 100 points from here is a 60% move, and you want to be in that move, right? So
yeah, I think, Dave, you're a professional. You manage money. You're a hedge fund manager. Do you think trying to time the market perfectly is a fool's game?
Yeah, totally. Especially now with all the central bank intervention, right? So what you really have to do is, sometimes you get it lucky. I actually bought most of my Russian stocks on December 16th, which was the day Russia bottomed. And actually that really helped my returns, because if you go look at it, that was an outlier day. They have none of those stocks have traded that low at all any other day. And not only that, they probably traded 10 to 20% lower that day than they have any other day. So sometimes you get it when there's a panic, but most of all, you just kind of average in. You got to buy good companies. You got to look for beat up assets, all of this sort of thing. So, in gold and silver, I've got some good junior miners. I got one that's trading at only 2-3 times cash flow, right? So I just look for some quality stocks, and I don't know, they might be dead money for a year or 2 years or 3 years or 5 years or whatever it may be, or 3 years. But when they go up like gangbusters. It's like buying gold stocks in 99, 2000. My first book was called Stock Market Panic, kind of similar themes to today, but it was published in late 1998, and I talked about buying gold in there. Well, buying gold in 99, 2000, you had to really wait till 2001 till the gold stock started to move, but it was more than worth it. By 2002, many of these stocks were up hundreds of percent. So, sometimes you just got to be willing to wait it out. I think even Templeton, one of his famous trades was he bought South Korea during the first phase of the Asian crisis in 97. And at the 98 low, South Korea was 20 or 30% lower from where he bought it. But within 2 years, he was up 200 or 300% on that trade. So it's sometimes you're going to be a bit early, and you just got to wait it out and that. So precious metals, it's really simple to me. I just think we're building a massive base. It doesn't look to me like we're going to fall to 1,000. I had that scenario in my mind for a while, but it looks like we've got some really, really good support here, in the 1130 to 1200 range. I think that's when the Chinese and Indian physical buying comes in to support the market. Especially India now has basically got rid of the ban they had on gold imports. They were doing that for the current account deficit for a while. So now you got India coming back into the market as a buyer, and we're sitting right below the 150-day moving average, which we've really only significantly took out once. That was in the spike actually earlier this year. So that's not saying that for sure we're going to move higher, but I would think that if we get above 1,300 especially 1,250, will look pretty good. It looks like we could really, really start something here to the upside. And I think a major factor, and the reason I feel better now, and I tried to front run this thing a few times in 2014, but the reason I feel so much better right now is the U.S. dollar. The U.S. dollar is an extremely one-sided trade. Almost all of the dumb futures money is bullish the dollar.
All the Keynesians, all the Wall Street Keynesians from Ivy League schools, Dave, who don't think like you and me, who haven't read, Sir John Templeton or anything contrarian, they're all hardcore bullish the dollar right now.
They all want to believe in this myth and forget the Canadian aspect. They want to believe in a story. That's what it is, a story, that the U.S. is going to be raising rates and we're going to go back to regular economic growth.
The U.S. is going to decouple from the whole economy,
the whole global economy, right?
But doesn't most of the Dow and S&P companies, most of their revenues now, like over 50% of the Dow and S&P companies, their revenues come from outside the U.S.?
I think it's 45%. And if you took out healthcare, because healthcare is almost all still in the U.S., right, especially stuff like HMOs and stuff, it'd be like 50%. So this isn't like 1984, right, when the U.S. dollar was going straight up. And, what were the Chinese and Indian economies back then? Nothing, right? So this isn't like back then. The U.S. corporations are much more dependent on foreign earnings, in Asia, in Europe, in places like this. So, that dollar would really, and we're seeing that now. We have terrible earnings right now, just in the little, really 100 is not that high historically in the U.S. dollar index. It's been as high as 250, so. It's just a little pop of 20% of the dollar has caused this to happen. So imagine what another 20% would cost. But anyhow, if we look at the technicals, the USD dollar index moved to just over 100 in early March, pulled back to about 96, went back to 100, and now is back around 97. So if it breaks those lows, which are about 96 in March, April, I would think that would be a sign that a top is in. And the market is probably telling you that these rate increases are not going to happen. And what happens, what's going to take for the Fed to do QE again? If we get a correction like we got in the summer of 2011, boom, the market's down. Go look how the market traded then. Most of that 20% correction happened in like a week, like 15 of that 20%. So boom, we get a terrible week in the market. The Dow drops 3,000 points, okay? They're going to be printing money like crazy again. And then that whole trade has to be unwound. And the USD will go back to the mid-80s. Very, very easy. And look, from a global macroeconomic standpoint of these economies, see, I don't look at Europe as, they're just lazy socialists. I think all these currencies are garbage. I think the U.S. has way too much debt. The U.S. is trying to, still trying to be the policeman to the world. Tons of unfunded liabilities. Europe is too socialist, has tons of unfunded liabilities. Canada has tons of unfunded liabilities. So all the Western currencies have all the same problems. So the euro may have more structural problems with all the different countries, but ultimately these currencies aren't that much better than each other. And by the way, Europe has a current account surplus. And when was the last time the U.S. had a current account surplus? So again, all these currencies have more negatives than positives. And in the end, I think you'll just see, I don't know if you're going to see a complete collapse in the dollar, but I think you'll just see, in the end, a dollar on the downside in the euro, or maybe 90 cents, I don't know, and then $1.30, $1.40 on the upside, and we just trade in that huge band. But if everyone's doing QE, if the U.S. joins the Japan and Euro party, then you see the commodity kind of stagflation trade start. Because then I think it gets to the point where, corporations can't do financial engineering anymore because the stock market tanked, and they're all printing money, and the economy is sluggish. So I want my money in a real asset, right? Like gold and silver. Even though the fundamentals may be terrible for iron ore or copper, you know what? That's stagflation. They'll go up in that environment too.
Yeah, I don't think the base metals like copper or coal or iron ore or steel, I don't think they're long-term investments anymore. I think they're trades. But I still like food. I still like agriculture long term because I still see, the developing world, China, India, they're going to want to eat better food, more calories, probably more proteins, and energy, whether that's oil or natural gas. I think the one energy that I think politicians all around the world have kind of agreed they want to basically just phase out or eliminate is coal. I think that one, I think there's going to be a struggle for global demand increases for coal.
Here's the thing, okay? I agree. I know that they're definitely trying to phase out coal, but let's again look at it. Coal is very cheap right now. This was the last point because we've talked long enough, but I'm not that down on coal as a trade because here's why. In 2016, if we get a big bust in the markets, it's probably more likely that a Republican will be in the White House, okay? And then you got a Republican Congress and Senate with a Republican president, much more coal friendly at that point, okay? And coal stocks are already down 80-90% from their highs, so they're all very cheap. Because I think the current administration is almost trying to put that industry out of business, like you said. And then if I'm right, and you get the shale oil shale oil junk debt bust, well, then it's natural that you would start mining coal again because you're not going to be able to get money from, to drill a shale well. So you may actually see coal have a little blip. Like I agree, long-term coal, I don't know, right? And with solar getting cheaper and cheaper, et cetera, coal is going to make less sense. But right now, when you look at the KOL, which is the coal ETF, peaking in 2011 at 48, and it's now down to 13. If that were to get under 10, I think you've got a really, really good, at least contrarian, at least a trade,
I think it's a trade. I think it's a trade, but I'd be very, if I made, 50% or 100% or 200% on it in like 2 years on a bounce, I'd be very wary of holding it longer. I'd be taking most of the money off the table.
Yeah, but again, like you look at these companies like Arch Coal, right? These companies, like this is where you get, like if they don't go bankrupt, that's the biggest problem right now. Are they going to go bankrupt?
Oh yeah, all the coal companies have way too much debt because they weren't expecting the coal market to collapse.
Yeah. But again, if you get this kind of like if you get this turn in it, these are the type of companies. Remember when one of Sir John Templeton's famous trades was he bought 100 companies trading $100 a share in 1941, and about a third of these companies were in bankruptcy. And that he put $10,000 into that trade, and that trade went to $100,000 in 5 years. So that's a real maximum pessimism reversal trade. Now you got to have some guts to do it, and you got to make sure these companies don't go bankrupt. But you look at something like Arch Coal. If you don't go bankrupt and you do see a short-term turnaround in coal, and look, man, I don't think for the most part you hold most assets longer than 2-3 years anyhow, because they go from cheap value to fair value in that time frame. But these are the type of things that can go up 10 or 20 times in value if you get a turnaround. And I think just a lot on this note, because both precious metal stocks do this anyhow. When they turn on the U.S. money printing again, and if I'm right, that leads to a stagflationary trade. Okay, for the first year or two of that trade, all commodities will go higher. Like you said, copper is a trade, iron ore is a trade, maybe not long term, but when you get that, it's like 2009, right? When the stock market bottomed, everything went up the first 6 months, even Greek stocks. So in that first year or two, you could see these things all kind of get taken away, but to the upside when that finally happens. And I'll just end off on that. Now, maybe we'll talk about those resources more next time, but definitely, we were talking about precious metals. I definitely think, to end off, the thing that I'm most bullish on precious metals right now is I really like the fact that the U.S. dollar is now showing signs of topping, finally.
Very good. Now, please tell our listeners where they can find your newsletter and also where they can find your book.
Yeah, addictedtoprofits.net is my newsletter. If you go there, I actually have a free list you can sign up for. I do deals once in a while, specials for the paying subscribers. I'm probably going to do my next one in early May. And really sign up for that because I'm going to do a new series right now called You Have Been Warned. And I'm going to show all these big-time money managers who are warning about a market meltdown just to kind of prove and back up what Jason and I talked about in this podcast. My book, Collapse, How the Federal Reserve Created the Stock Market Bubble and Why It Will Collapse, is available on Amazon.com. And actually, this weekend, I will be actually finishing off the second edition of the book, and I'll probably re-release the second edition sometime, conservatively by the end of the month, but I would think sometime within the next, probably by the 23rd or 24th of April, that will be out.
And have you thought about audiobooks yet? Because a lot of our listeners, they download this podcast on MP3. They want to listen, in their car or walking their dog. You should consider doing an audiobook and putting it on Audible to your book.
I want John Facenda. He's dead now. This is the old NFL Films guy with the deep voice. He'd be the guy I want reading it.
You should do that. You should put your books on Audible. It'll get to a wider audience of people. Because I think a lot of people, because of their attention spans, Dave, you and me read a lot, but a lot of people nowadays, they just don't sit down and actually read books or ebooks anymore as much. They like podcasts and audiobooks and stuff.
Yeah, no, I agree with that, because a lot of people just want to get it over with in an hour or two. Although I do find the Kindle books sell pretty well, and another thing too is I try to really keep my books short. I don't want to write these long 500-page hardcover books. They may say 300 pages on Kindle, but if I actually transfer that book into a hardcover, it'd probably be maybe 150 pages or something. I try to.
David Stockman has a 30-hour audiobook. His Great Deformation in full unabridged audiobook. It's over 30 hours. I haven't bought it yet.
No, it's a good book, but yeah, that's what I'm trying not to do actually, though. As much as I like Stockman. He's a brilliant guy. I think he put his whole life in the book, though. well, he's older, so why not?
Okay, well, I really enjoyed this discussion, Dave, and we'll have you back on in a couple months to check to see if the markets have fallen. But I think there's a lot of good risk rewards in commodities, most specifically oil, gold, and silver. People may not be getting good returns for those for the next, couple months, but there's some good dividend yields there, and as long as you avoid companies without too much debt, you have a chance to make really good profits with some decent dividends over the next couple of years.
Yeah, and also from a seasonal aspect, we're entering a very good time frame for gold and silver stocks. The kind of May to July period is usually very, very good. So that's another thing to keep in mind.
Okay, great. Well, thanks again for your time.